Hey traders and investors, it's Serge Berger here. Today I'm going to go through something real quick that I think every active investor, active trader, and even longer-term investors should have, and it's called a big picture area of reference. And what we're really talking about here is a moving average that you can use through the longer-term lens to kind of make sure you're not, when the market pivots in one direction or another, you're not going against a trend. So you can play around with this and come up with your own moving average. But what I've found works really well is anywhere between a 15 and maybe 17 or so month moving average. We're talking about monthly charts. So what you've got here is the S&P 500 chart. These are all monthly bars. And I'm using in this case, a 17-month moving average. You can tweak this a little bit. You can even make an exponential moving average for all you want. But I tend to use a 15, 16, 17-month moving average to give me a big picture. So you can apply this for equity indices. Works really well there. Works well in major equities themselves. So like Apple. Let me just quickly go through and show you how well this is working. It works in other asset classes as well, not in all of them, but generally it gives you a pretty good picture, particularly if you take the signals of this moving average or this big reference line in conjunction with other major signals, like what other asset classes are doing and things like that. So look at, for example, the S&P 500. When it topped out here in 2000, so it was a long time ago, it started breaking below this blue line. It really was game over, and the market started trending lower. Then it started ebbing out, started pushing back above this moving average in 2003. In the spring of 2003, started pushing higher for a good number of years. And then, of course, in 2007, we again broke below this move, or in early 2008, I should say, broke below this moving average. Let me take a little arrow here. Bottomed out here in 2009. And a little bit later that year, in August, actually, it started pushing back above this moving average. And for the most part, except for one wiggle out here in the early autumn of 2011, when we had the last sort of more volatile market, we haven't had any real volatility since. It's mostly held, and this would have been a good reference line to sort of sit up and take notice. And then, really crucially here, look at this in 2014. So last year in October, we had this volatile move, but really what the move did, all it did is it went back and tested this moving average for the first time in a long time. And on a monthly chart, you would have seen that it actually rejected that, and we've been marginally pushing higher ever since. You can then look at also, say, on the Dow Industrials. Just to give you another example. Same exact scenario here. Has more or less held, given us really good information when the trend has changed. Apple, for example, too. Again, this is a major stock. Obviously, considering your market cap, you can see for the most part. Also, for example, here, this has been a really good example. Last time Apple had a real good correction was in the second half of 2012 into the year first quarter or so of 2013. So once we bottomed out, by later in 2013, the stock had pushed back above this moving average and started pushing higher. So it's really important to have a big picture reference line of this so you don't lean against major market trends. I like to use a 15 or 17 month moving average for the broader indices. Please like this video, join or follow the YouTube channel, and I will see you in the next video.